Spend 4% of your portfolio in year one. Adjust for inflation every year after that. Your money lasts 30 years. That is the 4% rule, and millions of people treat it like gospel. You have probably heard it on a podcast, maybe a YouTube channel, maybe a Reddit thread at 11 at night when you were doing the maths on whether you could actually retire. Here's what nobody told you. That rule was built in America in 1994 on American stock market data, with American tax rules and no age pension. It was never designed for you. And if you're applying it to your Australian retirement, if you're using it to calculate how much super you need, there's a real chance it's either making your target unnecessarily out of reach or giving you false confidence in a plan that does not account for how Australian retirement actually works. Today, we're going to fix that. We're going to look at where the 4% rule came from, why Australia's retirement system is structurally different, what the real numbers look like for an ordinary Australian at 67, and what withdrawal rate actually makes sense depending on your balance and your situation. The 4% rule comes from something called the Trinity Study. 3 finance professors in Texas, 1998, they looked at rolling periods of U.S. stock and bond returns going back to 1926 and asked a simple question. What is the highest withdrawal rate a retiree could have used in the worst historical periods without running out of money over 30 years? The answer they landed on was 4%. Spend 4% of your starting balance in year one. Adjust that amount for inflation every year. Across nearly every historical 30-year period they tested, including the Great Depression, a balanced portfolio of U.S. stocks and bonds survived. It is a genuinely useful piece of research. The problem is not the research, the problem is what happened next. The 4% rule escaped the academic paper and became a universal rule of thumb, repeated across podcasts, forums, and finance content globally, without the asterisk that matters most. That asterisk is this. The study used American markets, American bonds, American inflation, and an American investor with no government pension to speak of. Take it out of that context and the number changes. Australia's retirement system has 3 features that the Trinity Study never modelled. The first is tax-free super withdrawals. In the United States, when you pull money from a retirement account, you pay income tax on it, every dollar. A U.S. retiree drawing $60,000 a year might lose $8,000 to $12,000 of it in federal tax before it hits their bank account. In Australia, super withdrawals after age 60 are completely tax-free. That same $60,000 drawn from an Australian super fund in pension phase arrives whole. That single difference makes a 4% Australian withdrawal functionally equivalent to a 4.5 to 5% pre-tax withdrawal in the US. The second difference is franking credits. When Australian companies like BHP or Commonwealth Bank pay dividends, they pass through a credit for the corporate tax already paid. For a retiree in a 0 or low tax bracket, those credits come back as a cash refund. On a portfolio with meaningful Australian equity exposure, that adds roughly 0.5% to 1% of effective annual return. Compounded over decades, that is not a rounding error. The third difference is the age pension. This is the big one, and it is the one most people using the 4% rule get completely wrong. Here is the thing most finance content will not say plainly. The 4% rule, applied blindly to Australia, inflates your required super balance significantly. And for the median Australian, following it without modification could mean working 3 to 5 extra years for no reason. Let me show you the numbers. The 4% rule says you need 25 times your annual spending saved before you can retire. Want to spend $50,000 a year? You need $1.25 million. Want 60,000? You need 1.5 million. For most Australians on ordinary incomes, those numbers feel impossible, and so people either give up on planning entirely or they keep working past the point where they needed to. Here's what that calculation is missing. As of March 2026, the maximum full age pension pays $31,223 per year for a single person. For a couple, that is $47,070 combined. That income does not come from your super balance. It is not subject to the 4% rule. It is a government payment, means tested, indexed twice a year, and available from age 67. Now consider the median Australian approaching retirement. The median super balance for Australians aged 60 to 64 is around $201,000. Not $630,000, not $1.25 million. $201,000. Apply the 4% rule to that balance and you get $8,040 a year from super. That is nowhere near enough to retire on. The standard advice would tell that person they cannot retire, that they are hundreds of thousands of dollars short. But add the full age pension for a single homeowner and the picture changes completely. $8,000 from super, $31,000 from the age pension. That's nearly $40,000 a year before they have spent a single dollar above the 4% rate. And here's where it gets more interesting still. A single homeowner with assets under $333,000, including super, qualifies for the full age pension. Their super balance is actually small enough that the government supplements their income at the maximum rate. The 4% rule was built for a system with no flaw. Australia has a flaw, and for ordinary Australians, that flaw changes everything. The reason this gets complicated is that Australian retirement does not work in one phase, it works in two. Phase 1 is age 60 to 67. This is the gap period. Super is accessible from preservation age, which for most people is 60, but the age pension does not start until 67. In this phase, you are drawing entirely from super. No government support, just your balance and your returns. This is actually where the 4% rule is most relevant for Australians, specifically in this window. If you retire at 60 with $300,000 in super and plan to fund 7 years entirely from that balance before the age pension kicks in, you need to be disciplined about your draw rate. Sequence of returns risk is real. A bad run of markets in the first 3 years of retirement can permanently damage a portfolio that never gets time to recover. Phase 2 begins at 67. The age pension arrives, the income floor appears, and suddenly the pressure on your super balance drops because your essential spending is being partially or fully covered by a payment that is not coming from your portfolio. In Phase 2, the sustainable withdrawal rate from your super can be meaningfully higher than 4%, particularly for those with median or below median balances, because you are not relying on your super alone to cover your full cost of living. For a retiree with $200,000 in super, receiving a near full age pension, drawing 6 to 8% from their super account is not reckless. It is actually the intended design of the system. Run down your super, increase your age pension eligibility, and use both together. Now, here is the part most of these videos skip. This only works if you plan it deliberately. The age pension is means tested. Centrelink looks at both your income and your assets. And the assets test has a taper. For every $1,000 of assessable assets above the threshold, your pension reduces by $3 a fortnight. If you enter retirement with a large super balance and simply apply the 4% rule, drawing slowly, preserving capital, you may spend your entire retirement sitting above the assets test threshold. You get less age pension than you are entitled to, your super takes longer to draw down, and you leave a large balance behind when you die, which was never the goal. The deliberate strategy is different. It means understanding your assets test position at 67. It means knowing the full pension threshold, $333,000 for a single homeowner, and the part pension cutoff of $733,500. It means modeling the interaction between your draw rate and your pension entitlement across a 20 to 25-year retirement horizon. It is not complicated once you see the structure, but you cannot see the structure if you are applying an American rule to an Australian life. So what is the real number? There is not one number. There are two questions you need to answer. First, what does your Phase 1 withdrawal rate need to be? If you retire at 60 with $300,000 in super and a 7-year gap before the age pension, the 4% rule is actually a useful guardrail in that window. Do not blow the balance before 67. Second, what does your Phase 2 income look like? At 67, run the age pension means test on your projected balance. A single homeowner with assets under $333,000 gets the full $31,000. Between $333,000 and $733,500, partial pension. Above that, no pension, and the 4% rule becomes more relevant again. Most ordinary Australians land in the partial or full pension zone at 67. That is the retirement the system was designed to deliver. The ASFA Comfortable Retirement Standard, updated February 2026, puts the recommended balance at $630,000 for a single and $730,000 for a couple. Those figures already assume partial age pension support. They are not a 25 times multiplier. They are a system-aware number built for how Australian retirement actually works. Run your own two-phase model, not an American one. And if you want to see how this plays out when you are still in the accumulation phase, still trying to decide between paying off the mortgage early and putting money into super, that is exactly what we are covering next. Because that decision, for an Australian on $80,000, is more complicated than most people realize, and the conventional wisdom is quietly costing people more than they think. That one is up next.